Today, I will be going over the biggest mistakes that can kill your 1031 exchange and how to avoid them. The IRS deadlines are non-negotiable. You have 45 days from the sale of your property to identify potential replacements and 180 days to close on one of them. There are no extensions unless a federally declared disaster applies. If you miss the 45-day identification window, even by a single day, your exchange fails. For example, if you try to identify a property on day 47, you're out of luck. Never touch the money yourself. All funds in a 1031 exchange must go through a qualified intermediary. If you ever take constructive receipt of the funds, even for a moment, your exchange is disqualified. This is why it's crucial to set up the exchange with your qualified intermediary before closing on the sale. One mistake here and you're writing a big check to the IRS. Not every property qualifies. A 1031 exchange requires like-kind investment property. That means you can sell a rental and then try to buy a primary residence or a second home. Vacation homes can qualify, but only if you carefully follow IRS safe harbor rental rules. If your intent is personal use, the IRS will reject it. Not following the identification rules is another common error. The IRS gives you three main options: the 3-property rule, the 200% rule, or the 95% rule. For example, if you identify 5 properties worth more than 200% of your relinquished property's value, you must close on at least 95% of that value. Otherwise, the exchange fails. Knowing the rules up front protects your strategy. Intent matters more than anything. The IRS requires that your replacement property be acquired for investment purposes. If you move in immediately or treat it like a vacation home right away, you risk disqualification. Safe harbor rental periods exist to help protect you, so follow those guidelines closely. Do not forget about the math. If you trade down in value or debt, you'll trigger taxable boot. This includes closing costs, loan balances, and mortgage payoffs. For instance, if you sell a property for $1 million but only reinvest $900,000, the $100,000 difference is taxable. Planning property keeps you protected. Poor planning is the silent killer of 1031 exchanges. Waiting until after your property sells to talk with a QI or map out replacement properties leaves you scrambling. That leads to fewer options and bad negotiations. The earlier you prepare, the smoother your exchange will go. Don't assume state rules match federal rules. Some states require special reporting or even withholding for 1031 exchanges. Moving your investments across state lines without understanding those rules can result in unexpected tax liabilities. Work with a professional who knows both federal and state requirements. A 1031 exchange is one of the most powerful tools investors have to build wealth, but it comes with strict rules. Missing deadlines, touching the money, choosing the wrong property type, or underestimating costs can all trigger taxes. Careful planning and the right team protect your exchange and maximize your return. If you're considering a 1031 exchange and you want to avoid these mistakes, make sure you give me a call.